You work harder every year, yet your debt only grows, and that is not by accident. Banks have perfected a system where your future earnings quietly become their profits, thanks to legal contracts and the power of compounding interest. What is really happening each time you borrow money? And why is escaping this cycle so difficult for ordinary people? Debt at its core is borrowed money that must be paid back, with extra charges layered on top. For most people, this means loans, credit cards, and mortgages, each with interest and fees attached. The debt trap happens when those charges eat up so much of your paycheck that paying down the actual amount you borrowed becomes nearly impossible. Instead of shrinking, the balance can hold steady or even grow, especially if you need to borrow more just to keep up with payments. In this system, every dollar you get today is a promise to hand over your future earnings, month after month. When income does not keep pace with what you owe, the cycle tightens. Banks and lenders benefit from this arrangement, collecting streams of interest while you struggle to break free. The longer the debt lingers, the more profitable it becomes for them. Interest is the price you pay for borrowing money, but the real engine behind bank profits is time. With every loan or credit card, interest charges are calculated again and again, not just on the original amount you borrowed, but on any unpaid interest from the month before. This is compound interest. Over years, even a modest rate can snowball into a mountain of extra payments. Early on, most of what you pay goes straight to interest, not to shrinking your debt. Amortization schedules are built so that lenders collect the bulk of their earnings up front, while the principal barely budges. The longer the debt remains, the more interest piles up. Banks don't need you to pay off your balance quickly. They make more when you pay slowly, stretching out the life of the loan. Time itself becomes their most valuable asset, turning every delay into more revenue. A family buys a $300,000 home with a fixed 30-year mortgage at 6%. Their monthly payment is about $1,799 a month. Manageable on paper, but the numbers tell a different story. Over those 30 years, the total paid back to the bank reaches nearly $648,000. Of that, $347,780 is just interest, more than the original price of the house. In the early years, almost every dollar goes toward interest, while the principal barely moves. For years, the homeowner feels like they are treading water, sending payment after payment, but seeing little progress. This is not a rare outcome or a hidden penalty. It is the standard structure of a long-term loan. The real cost of borrowing stretches far beyond the sticker price, and the bank collects steady income every month, year after year. For most people, this is the only way to own a home. For banks, it is a formula that quietly multiplies profits. A single credit card statement arrives, showing a $5,000 balance at 20% interest. The minimum payment is just 2% of that balance, about $100 this month. It feels manageable, even routine. But if the cardholder pays only the minimum each month, the debt barely shrinks. Interest keeps piling on top of interest, and the required payment drops a little every month, making it easy to keep the cycle going. According to the Consumer Financial Protection Bureau, at this pace, it would take 32 years to pay off the original $5,000. Over that stretch, the total interest paid reaches roughly $13,000, more than double the starting amount. The statement never warns that the minimum is a trap, not a solution. For many, the promise of flexibility turns into decades of quiet, legal extraction, with the bank collecting far more than the cardholder ever borrowed. Banks and lenders follow the letter of the law. Contracts spell out every detail, sometimes across dozens of pages. The Truth in Lending Act and the Card Act require that interest rates, fees, and payoff timelines be disclosed, though the fine print often buries the real costs. Student loans take this even further. Over $1.6 trillion is now owed in the U.S. Much of it is backed by federal policy that treats debt as the price of a diploma. A recent graduate facing a stack of loan statements finds each one perfectly legal, every term approved by regulators. Yet the complexity and length of these agreements make genuine understanding rare. The rules are clear. The system is designed to encourage borrowing, and the law stands firmly behind it. Prices for everything from rent to groceries have climbed almost twice as fast as paychecks for most workers since 2000. According to the Bureau of Labor Statistics, the Consumer Price Index has soared by about 80 to 90%, while real median wages have edged up only 8 to 15%. This widening gap leaves families stretched thin, relying on credit cards or personal loans to cover emergencies or rising bills. As debt builds, so does the mental toll. Constant worry, sleepless nights, and the sense that no matter how hard you work, you are always behind. The stress itself can push people to avoid bills, deepening the cycle. Banks routinely report double-digit returns on equity, fueled by interest collected on long-term consumer debt. A simple rule: debt that helps you earn more or build lasting value can be productive. Debt taken on just to cover spending often leaves you further behind. Today, household debt in the US tops $17 trillion, while banks post record profits. As rules favor lenders, the real cost is not just interest, it is futures quietly mortgaged away. Share your thoughts below.